Hey, what's up, everybody? Welcome back to Investing Sucks. And today we're going to be taking a look at retail stocks. And we're going to talk about retail stocks because I don't know about you guys, but it seems pretty much every retail stock that I look at appears to be significantly undervalued, or at least a little undervalued. Now, I don't mean that in the sense that it's time to drop everything and go out there and buy retail stocks hand over fist. Because obviously, if a whole sector appears to be cheap, then there's probably a valid reason for it. But you can't deny that a lot of companies in this space, at least at the surface, appear to be pretty good deals. So that's what I want to explore in this video. I want to start by showing some quick summary metrics of this industry overall, and then dive into one specific company that I think is starting to look interesting from a value perspective. So I put together a few charts here that I think tell a good story of the retail industry, and the focus of this video is going to be specifically on specialty retail stocks, which are typically smaller retailers that will prioritize one specific type of product, whether it's like auto parts, bath products, outdoors equipment, you get the idea. So what this chart is here, this is a custom chart that I created, and this here is my website, by the way. It's called tickernomics.com. It's a website that's currently free to use, and I'll leave a link in the description of this video if you guys want to look at some of the features because we're currently getting user feedback and improving the website. But anyways, the idea with this chart here is it shows the total sales on a quarterly basis for this industry overall. So all the companies in this space. And we can see for a long time it followed a pretty stable pattern, right? You saw this kind of uptick in the later months of the year, kind of in the holiday season. And then it was growing slightly, but still mostly flat. It started growing a bit more here. And then obviously once 2020 comes around, there's that thing that happened that causes some industries to do very well and others to not do so well. Specialty retail was particularly a beneficiary here because as you saw, there was kind of this drop right as the lockdowns were happening when things were very uncertain. But then later on, people started receiving stimulus checks and things started to open back up in certain areas. And you saw a significant uptick in total sales here. What you would consider above the trend line that we can observe this trend line going here. But ever since then, it's kind of been dying down a bit, right? Again, it's been pretty inconsistent, but it's been going down a bit. So that's sales, right? Now let's look at net income. So that's what this is here, because this is arguably, looking at how much of your sales are actually getting converted into bottom line. And it's kind of what you'd expect, right? Once the lockdowns start to occur, I mean, net income pretty much goes to zero. Some of these companies are probably running losses, but then they experience this unexpected bump because things actually turn out better than people had initially thought. And the net income starts to go way above what the trend line would be. But then, kind of as we get into 2022 and then in 2023, things start going down, right? So there's this initial jump that was caused by the stimulus checks and other things. And then as inflation starts to set in, people get more cautious with their spending. You start to see this go down a bit. Now, I wanted to see how the valuation level of this industry changed. So this is basically a price to earnings ratio for the entire industry, right? So the total market cap of all the stocks divided by the total earnings of all the stocks. And this doesn't really tell us anything super insightful. It's pretty much what you'd expect. And it was actually pretty consistent overall. Again, there's this unexpected jump here, but if we look in the more recent months, it's been pretty consistent between, 18 to 25 uh, PE multiple there. So, nothing drastic has changed in this industry, but it is an interesting development where you had certain companies that did, specialty retail in particular, they did quite well coming out of the lockdowns. But now, as the reality of the economy is starting to set in, they aren't doing as well. Now, the last thing I was interested to see was the actual companies that were performing the best. So for this, I created a table in here, and this table, it shows us for all the specialty retail. So we have Indigo, Best Buy, Barnes and Noble, Pet Value, a whole variety of different companies here. We have the market cap, their operating margin, and then over the past 3 years, so until October of 2020 until now, what was their annualized returns, their returns per year? Because I was curious to see what the best performing companies were. And there's a few NANs here. Um, these companies haven't been around for 3 years, so they don't have data. But the best performing company in this space, which returned over 100% per year for 3 years, was Build-A-Bear. That's right, Build-A-Bear was the best performing one. And I mean, 100% for 3 years, that means, you would have turned, say, $1 would have turned into something like $8 over 3 years at that rate. So pretty strong performer. But if we actually, look at what happened with this company, a lot of this just comes down to the timing. This wasn't like, some spectacular, turnaround and some huge success story. It was kind of just for a brief period in time, things were not looking good. We can see here. And then the company was able to turn things around pretty well, right? And we can see they, surprised a lot of investors. But then the second best performer in this space was, spoiler alert, the company we're going to be looking at, which is Academy Sports and Outdoors, at almost 50% annualized. And again, we're going to dive right into this company and we'll see specifically what happened. But overall, a lot of retail stocks have done well. All these companies here would be, companies that have outperformed. But at the same time, there's going to be some that haven't done so well as we get into these ones here. Yeah, a lot of variance in this industry. Some companies have really had a tough time, dealing with what's been going on in the economy for the past few years. So that just gives you a high level overview of this sector. Now let's actually dive deeper into ASO, or Academy Sports and Outdoors, because this is a company that is starting to get talked about a lot more. A lot of people are saying it's getting interesting from a value perspective. So let's dive into it now. So, Academy Sports and Outdoors, I'll just be calling them ASO throughout this video. They are a sporting good and outdoor retailer based out of the US, and they actually only currently operate in 18 US states, primarily in the South, although they do have plans to expand more into the northern states, and in the future, they have plans to open up a lot new stores over the next 5 years. That was a big focus of their most recent earnings call. They currently have 270 stores within those southern states they currently operate in. And their whole value proposition is them being this value option for people. So they try to offer the lowest prices out there, and about 20% of their sales do come from their own private label brands, which is a big deal because those brands tend to offer more value for customers because they don't have to charge as high prices since it's their own brands that they're selling. And then the remainder would come from brands they either have exclusive deals with or brands that they get preferred access to, which tend to be the more recognizable brands. So companies like Nike, Adidas, Under Armour. And we're going to talk about later about why that's a big deal and why, because of what those companies are doing specifically, why that's actually or could be a unique competitive advantage for ASO. So I'll get more into that later. But that gives you an idea of the actual merchandise they sell. And then a lot of it is also, stuff related to fishing, hunting, just general outdoors activities. So the story of this company is, for a long time they were owned by private equity firm KKR, and then in October of 2020 they actually went public. And it was a pretty disappointing IPO overall. And this did make sense at the time because the general thesis with a lot of these specialty retailers, or specifically these sporting goods retailers, was they experienced this temporary boost during the lockdowns because of the stimulus checks that people were receiving and because people were doing a lot of things outside. People were basically reduced to all their hobbies, all their enjoyment having to be outside as opposed to doing stuff indoors. And a lot of the stuff they would normally do, they couldn't do anymore, right? So all that built up spending that maybe they spent on doing indoor activities, whatever those were, is now going to get allocated to somewhere else, right? So they were a huge beneficiary of that. It completely changed their business. I'll take a look at, the financials in a sec to show you what that actually looks like. But generally, people understood that that was the case, but they thought that in the future was things were just going to revert back to what they were before. And that actually isn't what happened. So if we go and look at their financials here, we'll look at their income statement on a quarterly basis. And I want to focus first on these operating margins because these tell a pretty good story. Now, we don't really have that much data to go off of, before the lockdown period because they were really only public, or there's really only a few quarters of data on them before that. But if we look at their operating margins, so this is Q4 2019, it was 3%, Q1 2020, 1%, and then Q2 2020, it goes up to 11%. We could see 6% here in the next one, 8%. So this is kind of, this was pretty industry standard at the time. But then what we see starting to go forward is, their margins increase drastically. Specifically, once we get into 2021, we could see 15%, 14, 13%. So the question was, is this going to actually be sustainable? And it appears so far that it has, right? I mean, their margins have stayed much higher than they were, in that pre-lockdown era. And continuing to go forward, they're still quite strong. Now, they have come under some pressure lately. We can see they decreased a bit, 12%, 12%, and then 9% here, just because of inflationary pressures, and then also something they refer to as shrink, which basically is like theft in their stores. Theft in retail stores is actually starting to become a real problem, and a big news headline a few weeks ago was that Target is basically closing down stores in some key areas because of how bad the theft has gotten. And this is also a problem for them. So certain things like that have caused their margins to be a bit under pressure, and they aren't quite as healthy as they were going back to this period here when, everything was seemingly going well, despite everything that was going on after the lockdowns occurred. And then their gross margins have stayed pretty constant, right? So not much change here, really just in the mid 30s range. Even if we go back here, it was still in the mid 30s range. So they just got more disciplined with in regards to their expenses and revenue. Of course, revenue is going to fluctuate quarter over quarter. It hasn't really, grown drastically in the past few years. It's kind of been around that, 1.5 billion range with some fluctuation in the middle there. Even if we go back to before they were a public company, it wasn't that much lower than it is currently. For example, here, I mean, this quarter, 1.3 billion, and their most recent quarter was, about 1.6 billion. So not a huge change. Of course, some change because they've opened new stores since then. But really, a lot of this improvement just comes down to their expense management. Now, there's a few key things to know about ASO that actually make them unique in this space compared with other companies. And if we think about other companies we can compare them to, there's some obvious ones. For example, Dick's Sporting Goods is one that comes to mind, but then there's some less obvious ones as well, like this one, Hibbett, which is also a, sports and outdoor recreation retailer. There's this one called Sportsman Warehouse, and then Big Five Sporting Goods. But these are all relatively smaller companies. We can see 500 million and then under 200 million in market cap for these two companies. ASO has about 3.5 billion in market cap, whereas Dick's is the largest by quite a lot at almost 9 billion. But there's quite a lot of differences between these, except for this one, which is the price to earnings ratio. Sportsman's does stand out quite a bit here, but as for the other companies, they all again appear to be very cheap. ASO has about 6.5, and we can see 8 here, 5.4, almost 9 here. And then in terms of the operating margins, so this is what their operating margins have been over the last 12 months of results that have been reported. We can see ASO has by far the largest one at 13%. This company is currently negative, which probably explains why their PE is so high. Maybe they just had a bad quarter or something. But then some of these other companies, they aren't nearly quite as high, right? Dick's Sporting Goods, which would be the most comparable one, is under 10%, right? So Academy Sports and Outdoors, we talked before about that expense management that they showed. So it's showing through here on their margins as well. And then, so this is revenue growth. Now, this isn't just revenue growth this quarter versus the same quarter 1 year ago. This is revenue over the last 12 months versus revenue over the last 12 months as of 1 year ago. And they're actually the only company that has grew their revenue when you look at it from that lens. And they grew it almost 6%, whereas all these other companies have declined by mostly double digits, right? So clearly, ASO is doing something to stand out in that regard. Now, some other things that are important to note is when you look at them on a revenue per store basis. Now, this is going to vary a lot depending on the companies because different companies in this space, and we're using like the same five companies here as I was, showing that table. But certain companies are going to have different strategies. They're going to have different, sizes of their stores. But overall, ASO has the best revenue per store at $23 million in revenue per store by, again, quite a lot, right? Now, this company, Hibbett, and then Big Five, these typically operate much smaller stores, right? So these aren't really fair comparisons. But if you compare them to Dick's Sporting Goods, for example, they are much more efficient in their stores. And there's many reasons for this. One reason is going to be just their stores tend to be larger. But another one, and this is a very important thing to note about ASO, is that they have very, very unique customer loyalty. And this is something that they've built up over a number of years by number one, committing to offer the lowest prices out there. And then they also have a lot of private label brands, like I said before, which they can price those relatively lower, but they're still high quality. So customers obviously appreciate when you offer them really good value, so decent quality at a very cheap price. And it's through that they've been able to build up over a number of years this customer loyalty. And I think part of what you're seeing here in their revenue store reflects that. And that's also led them to be more resilient and, still being able to maintain strong revenue in a time period where, a lot of economic indicators are pointing to customers pulling back on some of their discretionary spending. So, with a company like ASO, it's actually a pretty easy business to understand. You can imagine that their performance is going to be tied to number one, how many new stores that they can open and how many new markets that they can expand to. So, new states in the US that they can expand to in the northern part. And then also just general economic factors, right? Like disposable income, unemployment rates, and debt service costs, which would reduce disposable income. And I think the perception right now is that a lot of these metrics are not looking too good. But if we look at what these metrics are actually at right now compared to where they've been historically, that's actually not really the case. For example, this is the unemployment rate in the US overall. And if we take a look at what it's been here, we'll zoom out to about, we'll call it 5 years here. It really hasn't, it's gone up a little bit as we can see a slight increase here, but it's not like it's increased drastically to the point where, you're going to start to see sales fall off a cliff for this company. And then if we look at here, which is real disposable income, this is from the Fed website itself, and we're looking at what this has been over a period of about a decade. We can see it's been pretty much increasing in a pretty stable trend line, except for this period here, which we all know what happened here. And then it kind of decreased a bit here, but it's been relatively flat over the past year or so. So it's not like disposable income, again, is falling off a cliff. Obviously, with interest rates higher, you're going to see less, disposable income. That's just, a natural cause and effect. But the perception that maybe some investors have about these types of companies, these specialty retail companies, is people are going to put off these purchases, right? They aren't going to make these purchases now if they're not needed, just because of inflation and higher gas prices as well. People just simply don't have as much spending as they can do. So the question that I would have is how can investors, get a leg up on the competition? So how can we understand this company better than other people out there, given all these trends that are going on, to help us get some leg up and understand the company better and hopefully, make outsized returns by investing in it. So what I did was I just did some pretty simple research and I found a few different investment theses that people have been proposing about ASOs specifically. And this gets into the more micro details. So this gets very detailed on this company and it helps you understand, what's actually going on. And some of these I agree with, some of these I don't agree with, but I have four here and I'll just go through them pretty quickly. So this one here, this is probably the most convincing one. I'd say this one, and then also this next one here, which looks at Nike and Adidas, which I said before we'd be talking about these companies later and why this matters. But basically, the lockdowns that occurred forced people to pick up new hobbies, new, outdoors hobbies. And given the length of the lockdowns, which is nearly 2 years, people changed their spending habits by picking up these new hobbies. And we know that hobbies like outdoors related ones, like hiking, fishing, camping, hunting, whatever, these might be sticky hobbies that once people pick them up, they're now hobbies for life. And if that's the case, then there's going to be no more, reversion to the mean for these retailers. And, there's going to be increased spending on these types of hobbies, which obviously ASO benefits from going forward into many years into the future. So that's one thing, right? Again, it's a little convincing, but I wouldn't give too much credence for this because, you're projecting a lot here. You don't know for sure that this is going to be the case, and you're dealing with consumer tastes, consumer trends, which are very fickle and hard to predict. Now, this one I find a bit more convincing, and basically big, brands like Nike and Adidas, which ASO and other sporting good retailers will carry, are moving more direct to consumer. So the largest sporting wear stores worldwide have been trying to push customers into their own retail stores as opposed to, third-party retailers like ASO. And their stores tend to be in larger urban areas, and there is still a need for smaller retailers like ASO to give these brands access to these smaller cities they don't have these large presence in. And as these big brands have reduced their non-direct consumer footprint, the stores that remain carrying their products, such as ASO, will have increased traffic from people that still want to buy from these brands like, Nike and Adidas, because there's just less stores that carry them. These bigger brands, they aren't getting into new, retail accounts, right? They're kind of just maintaining the ones they have, and their strategy has really shifted to more, get people into our own stores. But that doesn't mean they're going to cut off all the other stores that have been carrying their products for a long time. So the stores that remain, which you can think of like Foot Locker, Dick's Sporting Goods as well, and ASO, are going to have increased traffic, like I said, from the people that still want to buy from these stores. Now, this obviously isn't certain, but it's pretty convincing in my mind. Now, this one is pretty simple as well. And it's basically just what the company has said in their most recent quarterly report, and it's their plans for the next 5 years. And they're looking to open between 10 to 15 new stores per year for the next 5 years, or even more than that potentially. And if they can do this, then the company is basically growing their revenue mid single digits or maybe even double digits as they go forward. Even if same store sales remain flat or even if they go negative slightly, just because of the fact they're expanding to new markets and opening up new stores means that they're going to increase their revenue, if they can do it properly. And each new store, on average, it adds about 18 million in sales in its first year. Now, this will probably be a bit lower for the stores that they're opening up in new markets, because like I said before, they only operate really in the southern states. If they start opening these stores in the northern states, their brand awareness isn't as strong there. So the sales are going to be a bit lower. And that is something that, I'm just not saying that was something that the company said themselves. So again, they only operate in 17 US states. They can expand into others. And then these store openings, they can be funded, pretty much a lot of them can be funded with internally generated cash flows and not taking on excessive debt. So if we actually open up this company, their debt balance overall has been very stable. So if we I'll just go to the charts here for ASO. And if we look at their total debt, we don't have too much data again because they only went public in 2020, but it's actually been decreasing, right? It's been decreasing quite a lot. And part of their, capital allocation in this period here when they had that, one good year in 2021 was they reduced their debt balance by quite a lot. And then I'll just mention this quickly, they've been buying back quite a lot of shares. So their share count has been decreasing by quite a lot. And that's been their strategy, reduce the share count. So overall, they're a pretty shareholder friendly company. So that's part of this thesis. And then the company did say that they want to open 120 to 140 new stores over the next 5 years, which would increase their footprint by 50%. So that can be pretty big if they are able to actually execute on that. And I can tell you from later on, we're going to jump into, a valuation of this company. But if they are able to actually achieve that, then the company is, valued pretty cheaply relative to that. So I don't think investors really believe that just yet, but that is what the company is saying. Now, this last one is one I read. It's a little bit iffy, but I'll just say it anyways. So one thing that's been well documented is this meteoric rise in weight loss drugs, right? So Ozempic, Wegovy, that big, I think it's a Danish company, Novo Nordisk. A lot of people have been talking about it. It's been growing very fast, and these drugs will ideally reduce obesity rates. And if obesity rates go down, this will lead to more people taking up outdoor activities as they feel healthier and they want to get outside more, which will lead to a rise in spending in retail stores that offer these products, which I don't know about this one. I mean, this one seems like a bit of a stretch. And to be honest, ever since this rise in weight loss drugs has become obvious to people over the past few months, it seems pretty much every industry out there has come up with some wacky thesis about how this is going to, benefit their industry in particular, which maybe it happens, maybe it doesn't, but I would not bank on this personally. Um, but yeah, like all these in general, I mean, I would classify all these as uncertain, right? They're the types of things that could happen, but you don't know for sure if they're going to happen. And the reason I say this is because if you contrast a company like this, which a company like this, again, you're dealing with consumer tastes, consumer trends, spending, all these types of things that are going to fluctuate a lot. If you compare this to, say, a company like a financial services company, with a financial services company like a bank or an insurance company that if interest rates go up, you know exactly what that's going to mean for the company. So then it just becomes a question of, okay, are interest rates going to go up? And once they do go up and you have confirmation of that, you can get a pretty good idea of what exactly is going to happen because those companies are forced to do things when interest rates go up. A company like this, has very variable results, right? It's pretty difficult to predict what's going to happen. So the question becomes, how can we, get more certainty, right? How can we understand this company better than other investors do? And one of the things we can start to look at is, more specific metrics for, companies that just operate retail stores, which could be things like, same store sales growth, the average basket size they have, so how much each customer spends when they're in the stores, store openings, all these kinds of things, and then see what the company's commentary on that is, and then you can get an idea of how these things are going to trend and what factors influence them. But this company doesn't really reveal a whole lot, unfortunately. I would wish, every quarter they would show certain metrics like average basket size, same store sales growth. And they do show that, but the way they calculate it is they have a lot of these weird adjustments to it, and it doesn't really make it comparable when you look at other companies. But one thing that I did find helpful, and this is their most recent earnings call transcript. And this is a trend that's been happening not just this past quarter, but a few quarters now, where so sales went down, sales in the current quarter versus sales in the same quarter last year, they decreased. And they saying sales were impacted by an 8.3% decline in transactions, partially offset by a 0.8% increase in ticket size, which ticket size would be, I'm assuming, how much each customer spends when they go into the store. So this is an interesting trend, right? Because to me, what it says is customers are just being more careful with how they spend their money. Maybe they've just been spooked a little bit by this high inflation, but the actual health of the customer overall is okay. And we're not exactly in this recessionary environment just yet. Now, that being said, again, if we look at the company's financials, there is a pretty clear downward trend recently in revenue growth, right? Like revenue growth in pretty much the past few quarters has been lower than it was for the same quarter a year ago. So there is pressure on the customer, but it's not like customers are being forced to spend less. It really seems like from that they're just deciding to spend less, right? They're just going shopping less because if transactions are down 8%, that's probably correlated with just 8% less people in the stores. But once people are in the stores, they don't have a problem, spending more this quarter than they were before. So I just found that interesting. And those are the kinds of micro level details that you can look at for this company. And they tell you a lot about how things have been trending over time. Okay, so the last step is, as promised, to do this valuation. And for this company, I'm going to use the value a stock feature on my website here, Tickernomics. And for this, we basically enter the ticker that we're interested in. It's going to load some company data for us, and then also calculate an initial DCF here, which we're going to make adjustments to this first. And I'm saying we should do a 5-year analysis. I think that's appropriate for this company. And one thing I want to point out before we get too in depth was a big thing that was mentioned in the company's most recent earnings call was the fact that they're expecting sales in the future to be lower than they may have previously, or may investors have previously thought they would be. The company didn't change their guidance at all for the year, but there was a significant change in expectations because if we look at what the actual stock price is now, $43 here, I mean, this is about the same as it was roughly 1 year ago. And it was a pretty significant decline from the top here about in the high 60s, which was only, in about May of this year, all the way now down to the 40s. So it's basically lost, about a third of its value just in a couple months. So a very significant change in expectations there, which is interesting because I mean, looking at the actual performance of this company, I mean, yeah, their quarters have been, getting worse, but it hasn't been, something that would warrant such a drawdown in the company. So it really comes from people's expectations. So that's, what I want to focus on for when we're doing this valuation is what sort of expectations do people have for this company? And then we can decide ourselves if we think that's reasonable. So I want to start with very realistic assumptions. So let's see what this company is valued if basically, they don't really open up as many new stores as we thought. Let's say they grow their revenue a little bit on a year-over-year basis, but that's just kind of because maybe, same store sales stagnates and they just open a few new stores. So we'll give revenue growth of 2%. Operating margin, let's go a bit more conservative at 12%. We'll keep the tax rate the same here, which is the value of what it's been as an average over the last 5 years. Capital expenditures, they did say that For CapEx, they're planning on spending between 200 and 250 million. So I'll just put this in the middle of that range going forward at 225 million a year. And then we can increase this depreciation amortization amount to say 130 as just a rough estimate. Now, working capital investments can be things like purchasing inventory. Obviously, this company is going to have to do that. So I want to make this, more in line with what it's been in the past 12 months, which we can see here was about 300 million. So let's assume, going forward for each of the 5 years, um, they have to make 300 million in working capital investments per year. And then the cash balance and then the leases, we can keep these pretty much the same. Uh, this is the multiple now. So this is an EV, so enterprise value to EBITDA multiple. If we look at what this multiple has been for this company historically, so we go to the charts here, we can see it hasn't really fluctuated that much. It's been pretty constant, except for this, big change here. Um, it actually hasn't been that constant now that I look at it, but what seems to be an amount that makes sense for this company is about a five, right? Which makes sense for retailers, right? These aren't super fast growing companies. These don't deserve super high multiples. Let's go conservative and keep that at five. The discount rate will change this to say 8%, something that makes a bit more sense. We'll click calculate DCF and then we'll see. So we get an intrinsic value of 33.01 and the current price is 43. So under these assumptions, things aren't looking too good for this company and we're going to say it's overvalued at this price. Now, I think we can be a bit more optimistic than this. These are all very, very conservative. I don't want to change this EBITDA multiple because as we saw historically, about a 5 would make sense. So let's make the operating margin something a bit more optimistic, 3% there, and let's say they grow revenue at 5%. So leave everything else the same. We'll just pull those two levers there. So just those two changes, I mean, make a huge difference. The intrinsic value goes up to just under $48. And now we can see it's pretty much fairly valued in this range. So this is pretty much what investors are expecting this company to do over the next 5 years. 13% operating margin, 5% revenue growth. But let's say they can grow their revenue by up to 50% within 5 years and hit that goal, that what they were saying before, which they want to grow their store footprint by 50%. They want to open up 120 to 140 new stores. So what that would mean is they would pretty much have maybe just under 10 billion in revenue within 5 years. So currently we're projecting about 8 billion in the year 2028. So we'll close the details there. Let's up this to say 8% and see how close that gets us to the mark. So I think this looks about like we're in that range, right? Maybe not quite, but we're pretty close. And at this price, the company is undervalued, right? 58 intrinsic value per share, but it's not really a screaming buy, right? So I really do think that this company has to grow much faster than personally I would be comfortable with assuming in order to hit these targets. But again, maybe some of you disagree with these assumptions and you think these should be changed a little bit. And if they are able to, really, hone in on their expense management, say they can get operating margins to 15%, which really isn't, out of the question for them. We can see what that does under these assumptions. I mean, at this price, it makes sense, right? Or at these assumptions, it makes sense. But yeah, that pretty much does it for this video, guys. So I hope you did find this useful and insightful. If you did, then please leave a like. And if you're new to my channel, I'd appreciate it if you would consider subscribing. And I'll see you guys in the next video.